Greetings, my name is Kevin Matthews and I want to welcome you back to Rapid Shots with the Tax Academy, where classes don't session because the learning never stops. In this video we're going to talk about what's called the Secure Act. Now the Secure Act was recently passed and it goes, and many of the provisions actually go into effect in 2020, so it's not going to affect your 2019 tax returns. And the only reason why we're doing this as kind of a Rapid Shots is there are some things that are individually required, or not individually required, but individually effective, that you might want to take into account when you're actually taking care of some of the stuff. So some of the important provisions that are being taken into account: number one is the RMDs are going to be increased. The age for you to take RMDs is going to be increased from 70.5 to 72.5. This kind of makes some sense in my opinion, because there are a lot of individuals who are in their 70s that are still working. Some because they have to, and then there's others just because they really enjoy what they do. We have several clients at our firm that actually the primary reason why they continue working is they actually just love what they do, and this is their passion, so they're going to continue working, and they don't necessarily need the money immediately. This gives you an additional 1.5 years because it goes from 70.5 to 72, and that actually makes things a little bit easier. For distributions, and now this will affect, for distributions required to be made after December 31st, 2019 for individuals who attain 70.5 after that date, the age at which the individual must begin taking distributions with a retirement plan is increased from 70.5 to 72. I think the biggest issue that we're going to run into with this, it's not the guys who are in their 60s, because this doesn't affect them yet. It's not the guys who are in their 75 and above, because this would affect them either way. I think it's the people who are right around that 69 to 73 age that are basically going to be like, hey, does this really affect me? And I think that's where you kind of need to talk to your tax professional in order to figure that out and see how that kind of works out. There's also a what they call the partial elimination of stretch IRAs. So for death of plan participants or IRAs who occur before 2020, beneficiaries who are generally allowed to stretch out the tax deferral advantages of the IRA by taking distributions over the beneficiary's life expectancy. However, for death of plan participants or IRA owners beginning in 2020, distributions to most non-spouse beneficiaries are going to be required to be distributed within 10 years. Okay, so what ends up happening is that you inherit an IRA from somebody who is deceased. There was calculations that we were able to do in order to be able to see how we would actually take out those distributions. Now, going forward, what's going to end up happening is that there's going to be this 10-year rule that we have to follow, and I think that again, that's something that you probably not just want to talk to your CPA or tax attorney, because obviously there's tax consequence effects of that. But something else that you're going to want to do is that you're going to want to talk to your financial planners about this too. And I know a lot of financial planners that I've talked to, at least some of the really good ones, are already pretty well read up on all this stuff. And just make sure that your person has a complete understanding of the Secure Act. And if they don't, then I don't know what to say at that point. Okay, so there's also an expansion of Section 529 education plans to include apprenticeships and distributions to repay certain student loans. This to me made a lot of sense. So for example, if I have a 529 plan but I had to take out a student loan in order to cover some expenses that maybe I wasn't able to get to the money in time, or the student loan was available to help out with some of that stuff. My opinion is that if it's geared for education and you used money from a loan for education, why wouldn't you be able to use education funds to be able to pay it off? It doesn't happen that often, but there are a couple times where I think it could be helpful. For a very good example is if you have a parent who, quite frankly doesn't think the kid is ready for college, and so tells the kid, hey, I think you need to take a couple of years off. You need to, age and mature a little bit. And then what ends up happening is the kid says, well, I'm going to go do my education anyways, improve myself. Not that I'm saying that parents are wrong all the time, but every now and then there's times where we are. And this would be a way that you could actually be able to do that. But also, I think the really cool thing about this is registered apprenticeships. One of the things that we're noticing in our society is that we have a lot of people who are basically being told you have to go to college in order to succeed. Well, a lot of those people are going to colleges and they're getting degrees that really aren't turning into job opportunities for them. And so what ends up happening is it works out to everyone's advantage if they have more options. And so, apprenticeships and trades, I was talking to somebody, a plumber out of school for 5 years, usually is making close to six figures, especially if they decide they're going to start their own business. It's actually a really good place to go, and I think that expanding this to include apprenticeships and trades, I think actually makes a lot of sense. They also changed the kiddie tax for Gold Star children and others. So one of the things that we noticed was, so there had been a concern that the TCJA unfairly increased the tax on certain children, including those who were receiving governmental payments, which was considered unearned income, because they were survivors of deceased military people. Now look, I'm not ashamed of this in any way, shape, or form. I'm a military veteran. I'm a disabled military veteran. I'm actually 100% permanently, totally disabled. But one thing that I've kind of come to the realization of is, if there's one thing that our society needs to do, we got to take care of our veterans who sacrifice, and especially those who pay the ultimate sacrifice. And the idea that a portion of the law might have unfairly increased the tax on those who are receiving these payments, to me just made no sense. So I'm actually kind of glad that they did this, and glad what they did with that. They're also going to allow penalty-free retirement plan withdrawals for expenses related to birth or adoption of a child. This is so what they're going to do is they're going to say, hey, look, if you have a birth of a child or you have an adoption of a child and there's some additional expenses that you need to have as a result of that, they're going to let you take out the plan. Now, before this law went into effect, if you were going to take out any money to use it for anything other than retirement or any of the specifically identified purposes, for example, buying a new home or paying for education expenses, you would be subject to a 10% penalty. Now, the good news is that the Congress has changed this rule and said, look, in order for you to have, if you have expenses related to the birth or adoption of a child, we're going to let you have that. Now, this could have some effects with some other tax benefits that they have related to adoption, so you want to make sure that you're talking to your CPA or tax attorney about that. So, starting in 2020, plan distributions up to $5,000 used to pay for expenses related to birth or adoption of a child are penalty-free, and the $5,000 on an individual basis for a married couple, each spouse may receive a distribution of up to $5,000. Okay. There's also taxable non-tuition fellowship and stipend benefits are treated as compensation for IRA purposes. Okay. Again, another thing that's kind of personal to me. I'm a doctoral student. So one of the things that they were noticing is that if you're in a graduate school, or if you're postdoctoral students who are receiving a stipend in order to cover your educational expenses in exchange for working for the university, it kind of didn't make any sense to me personally, but what would happen is they wouldn't treat that as compensation for purposes of an IRA. So if you're a single person, you're receiving this compensation, these stipends, and maybe the stipend's only like $20,000, but they're also paying for your room and board and all that sort of stuff. What ends up happening is that the $20,000 isn't a lot of money, but if you want to take some of that and use it for savings, because maybe you built up some savings before you went into the doctoral program, they want you to be able to continue doing your retirement. So that actually makes a lot of sense. So, tax-exempt difficulty of care payments are treated as compensation for determining retirement contribution benefits. So, compensation from difficulty of care payments are exempt from taxation because those workers do not have taxable income. They were not able to save for retirement for the qualified time. So basically what will end up happening is that any contributions that are made after December 31st, 2019 will qualify if you have those difficulty of care payments. Okay, it went a little longer than I expected, but we try to hit these topics at a very high level just to let you kind of understand. If you have any questions about any of this, feel free to reach out to me. You can go to the comment box below. Or you can reach out to us at our website at www.betasolutionscpa.com. Again, that's www.betasolutionscpa.com. And then we'll be able to reach out to you for more of a one-on-one consultation on this. If you guys like these videos, we'd really appreciate if you hit the like button. And if you if you really like the series, please go ahead and hit subscribe. And then that way, when these additional rapid-fire videos come out, we'll be able to help you out to know about them in advance. Again, thank you very much.